Inflation and taxes are steadily reducing the real value of retirement savings and inherited assets, even when account balances appear stable or growing. When prices rise year after year, each dollar buys less in housing, healthcare, food, insurance, and services. From 2000 through the mid-2020s, cumulative inflation erased a large portion of the purchasing power of fixed savings, meaning retirees must spend more dollars to maintain the same standard of living. This erosion continues quietly and does not require a market crash to do damage. At the same time, taxes apply pressure from another direction. Most retirement savings are held in tax-deferred accounts such as traditional IRS, 401, CAIS, and pensions. These accounts were funded with pre-tax dollars, which means every withdrawal is taxed as ordinary income. As withdrawals increase in retirement, taxable income often rises rather than falls. Required minimum distributions force retirees to take income whether they need it or not, which can push them into higher tax brackets, increase Medicare premiums, and cause a larger portion of Social Security benefits to become taxable. The combined effect of inflation and taxation reduces what retirees can spend and what heirs ultimately receive. A portfolio may show a positive return on paper, but if that return does not exceed inflation and taxes, real wealth is declining. For example, a 5% annual return during a period of 3% inflation leaves only 2% in real growth before taxes. After federal and state income taxes, the real return can easily fall to zero or below. Inheritance magnifies this issue. When tax-deferred accounts are passed to children or other non-spouse heirs, those heirs must pay income tax on withdrawals. Under current rules, most inherited retirement accounts must be emptied within 10 years. If heirs are in their peak earning years, withdrawals may be taxed at higher rates than the original owner ever paid. What looks like a large inheritance can be substantially reduced once income taxes are applied, especially if distributions coincide with high inflation and rising living costs. This process is not driven by bad decisions or unusual behavior. It is the normal interaction between inflation, tax law, and retirement account rules. Even conservative savers who avoided debt and market speculation face these pressures. The erosion happens gradually, often unnoticed, until spending power feels tighter or heirs receive less than expected. Government debt adds another layer. High debt levels increase the likelihood that governments rely more heavily on taxation and currency expansion to fund obligations. Retirees with documented assets and predictable income streams are easier to tax than the working population. This reality increases the importance of understanding how much of one's savings is exposed to income tax and inflation risk at the same time. The central issue is not whether money is being taken all at once, but how much is lost over time through reduced purchasing power and unavoidable taxation. Without accounting for both forces together, families often overestimate how secure their retirement income is and how much of their savings will remain intact for the next generation. For most American families, the greatest inheritance risk does not come from the federal estate tax but from income taxes on retirement accounts. The estate tax receives attention because it sounds dramatic, yet it affects a small percentage of households due to high exemption limits. By contrast, income taxes apply to a far wider group because retirement savings are commonly held in tax-deferred accounts that have never been taxed at the federal level. Traditional IRS, 401, KISS, 403 BSS, and pensions were designed to postpone taxes, not eliminate them. Contributions reduced taxable income during working years, and investment growth occurred without annual taxation. The trade-off is that withdrawals are fully taxable as ordinary income. In retirement, these withdrawals often become the largest single source of taxable income, sometimes exceeding what individuals earned late in their careers once required minimum distributions begin. When these accounts are inherited, the tax issue shifts from the original owner to the heirs. Under current federal rules, most non-spouse beneficiaries must empty inherited retirement accounts within 10 years. There is no requirement to take equal annual withdrawals, but the entire balance must be distributed and taxed by the end of the 10th year. This rule can force large amounts of income into a short time frame. For adult children who are still working, this income stacks on top of wages, bonuses, and other earnings. A beneficiary earning $80,000 per year, who inherits a $400,000 IRA, may be pushed into higher marginal tax brackets as distributions are taken. If the account grows during the 10-year period, the taxable amount increases further. In many cases, heirs pay a higher tax rate on inherited money than the retiree ever paid while alive. This taxation occurs regardless of how carefully the retiree saved or how modest their lifestyle was. It also occurs regardless of the will's instructions. A will determines who receives the account, but tax law determines how withdrawals are taxed. The IRS is not taking the inheritance through an estate tax assessment, but through ordinary income tax applied over the distribution period. State income taxes can add another layer. In states that tax retirement income or inherited distributions, the combined federal and state tax burden can remove a significant portion of the account's value. By the time all required distributions are taken, 20 to 40% or more of the original balance may have gone to taxes, depending on tax brackets and timing. This reality often surprises families because account statements show full balances, not after-tax values. A $500,000 IRA is not a $500,000 inheritance. Its true value depends on when withdrawals occur, the tax rates in effect, and the beneficiary's income situation. Without recognizing this difference, retirees tend to overestimate what they are leaving behind. The key point is that estate taxes are a narrow concern, while income taxes on retirement accounts are a widespread and predictable one. Understanding this distinction is essential to preserving real family wealth across generations. Much of the standard retirement advice given to older Americans fails because it focuses on investment performance while ignoring how and when money is taxed. Phrases like "stay invested," "don't touch your principal," or "wait until" required minimum distributions assume that taxes are a secondary issue. In reality, tax timing often has a greater impact on long-term outcomes than market returns, especially after full retirement begins. Waiting until RMDs start is a common example. Required minimum distributions currently begin in the early to mid-70s, depending on year of birth. By that time, many retirees have accumulated large balances in tax-deferred accounts. When RMDs begin, withdrawals are mandatory and increase each year. These forced withdrawals can push total taxable income well above what it was earlier in retirement, even if spending needs have not increased. This spike in taxable income can trigger multiple secondary effects. Higher income can cause more Social Security benefits to become taxable, moving from zero taxation up to 85% of benefits included in taxable income. Medicare premiums are also tied to income through IRMAA surcharges. A retiree may find that a required withdrawal not only creates income tax, but also raises healthcare costs 2 years later, reducing net income further. Advice that focuses solely on market exposure also ignores sequence of returns risk. Taking withdrawals during a market downturn can permanently reduce a portfolio, even if markets recover later. When RMDs are required, retirees lose control over timing. They must sell assets to generate taxable income regardless of market conditions, locking in losses during unfavorable periods. Another flaw in common advice is the assumption that retirees will naturally be in lower tax brackets. While some are, many are not. Pensions, Social Security, rental income, and RMDs can combine to keep taxable income higher than expected. Tax brackets may be lower earlier in retirement, before Social Security begins and before RMDs apply, but standard advice often overlooks these years as planning opportunities. General recommendations rarely consider how withdrawals affect heirs. Delaying withdrawals may preserve account balances, but it can also transfer a larger tax burden to children. Heirs may face compressed distribution timelines and higher marginal tax rates. Advice that is neutral for the retiree can be harmful to the next generation. Simplified guidance also assumes stable tax rules and stable personal circumstances. In reality, tax thresholds change, deductions phase out, and benefits interact in complex ways. A one-size-fits-all rule cannot account for these interactions. Without deliberate planning, retirees react year by year instead of shaping outcomes over decades. The failure is not in saving or investing, but in treating taxes as an afterthought. Retirement is not just a spending phase. It is a tax management phase. When advice ignores this, it leads to higher lifetime taxes, reduced flexibility, and less wealth transferred to family members. Effective planning requires attention to timing, control, and the cumulative effects of tax decisions over many years. Long-term financial protection in retirement depends less on chasing returns and more on controlling how money is taxed and accessed over time. Tax diversification is central to this approach. When all assets are held in tax-deferred accounts, retirees are exposed to a single point of failure, future income tax rates, and mandatory withdrawal rules. By contrast, holding assets across taxable, tax-deferred, and tax-free accounts creates options that can be used as conditions change. Taxable accounts allow withdrawals with more control over timing and amount. Only the realized gains are taxed, and in many cases at capital gains rates rather than ordinary income rates. These accounts can be used to cover expenses without increasing taxable income in years when managing tax brackets or Medicare thresholds is important. They also provide liquidity that does not trigger required distributions. Tax-free accounts, such as Roth IRAs, offer a different form of protection. Qualified withdrawals do not increase taxable income and are not subject to required minimum distributions during the owner's lifetime. This makes them valuable for managing income later in retirement, particularly when other income sources are already pushing tax thresholds. For heirs, these accounts generally provide distributions without income tax, reducing the erosion of inherited wealth. Tax-deferred accounts still play a role, but their use must be planned. Rather than allowing balances to grow unchecked until RMD age, gradual withdrawals over a longer period can reduce future tax pressure. Taking distributions during years with lower taxable income can flatten lifetime tax exposure, even if it means paying some tax earlier. The goal is not to avoid taxes entirely, but to pay them at lower rates and under controlled conditions. Planned withdrawals also improve flexibility. When retirees decide in advance which accounts to draw from and when, they are less likely to be forced into selling assets during market downturns. This reduces sequence of returns risk and helps preserve portfolio stability. It also allows retirees to respond to unexpected expenses without creating large tax consequences. This approach has worked across decades because it relies on structural principles rather than forecasts. Inflation, taxation, and market cycles have always existed, even though their specific levels change. Diversifying tax exposure and controlling withdrawal timing reduces dependence on any single outcome. It does not require predicting future laws or interest rates. Another advantage is its impact on inheritance. By reducing the size of tax-deferred accounts over time and increasing assets in tax-free or taxable forms, retirees can lower the income tax burden placed on heirs. This increases the after-tax value of what is passed on, even if nominal account balances are smaller. Long-term protection is achieved by viewing retirement as a multi-phase process rather than a single event. Early retirement years, mid-retirement, and later years each present different tax and income conditions. A plan that adapts withdrawals to these phases is more stable than one that follows rigid rules. The consistent principle is control. Tax diversification and planned withdrawals give retirees control over income, taxes, and timing. That control is what preserves purchasing power, limits unnecessary tax loss, and supports financial stability over long retirement horizons. A stable financial outcome in retirement is more likely when planning is built on durable principles rather than one-time fixes or assumptions about the future. Markets, tax laws, interest rates, and inflation levels change, but certain structural realities remain consistent. People live longer than expected, governments adjust rules to meet funding needs, and taxes are collected most efficiently from predictable income and documented assets. Planning that acknowledges these realities holds up better over time. Short-term strategies often fail because they depend on favorable conditions continuing. Attempts to time markets, concentrate assets in a single tax category, or rely on temporary tax provisions introduce fragility. When conditions shift, retirees are left with limited options. A framework that emphasizes flexibility allows adjustments without forcing large financial disruptions. One durable principle is inflation awareness. Even modest inflation compounds over long retirement periods. A plan that ignores this effect may appear sound for several years but gradually loses purchasing power. Adjusting income sources and withdrawal strategies to account for rising costs helps maintain stability without requiring higher risk. Liquidity is another enduring requirement. Retirees need access to funds that can be used without triggering large tax events or forced sales. Illiquid assets or fully tax-deferred portfolios reduce options during emergencies, market downturns, or periods of high taxation. Maintaining liquid reserves provides practical resilience. Periodic review is also essential. While predicting future laws is impossible, responding to current rules is not. Tax brackets, RMD ages, Medicare thresholds, and benefit formulas change over time. Reviewing plans at regular intervals allows retirees to adjust gradually rather than react abruptly. Incremental changes are easier to manage and less costly than large corrections late in life. A conservative assumption about longevity strengthens planning. Many people underestimate how long retirement lasts. Planning for a longer horizon reduces the risk of exhausting resources and increases the value of tax and inflation management. This approach prioritizes sustainability over maximum short-term income. Another stable principle is separating decisions about spending from decisions about taxation. Spending needs may be relatively steady, while tax conditions fluctuate. A flexible framework allows retirees to meet expenses from different sources, depending on which creates the least tax friction at the time. This separation improves efficiency without increasing complexity. This type of framework does not rely on predicting future returns, interest rates, or policy changes. It relies on spreading risk across time, tax treatment, and access. It also respects the experience of older individuals who understand that stability comes from preparation, not precision. The result is not optimization in any single year, but resilience across many years. By avoiding dependence on trends, shortcuts, or assumptions, retirees preserve control and adaptability. This steadiness, rather than aggressive tactics, is what supports long-term survival of both income and inherited wealth.